Let's unpack this together. The precious metals community has gotten real quiet about actual numbers lately. Everyone's shouting about gold hitting new records, silver squeezes, and economic collapse, but nobody wants to commit to the uncomfortable question: exactly how many ounces do you actually need to weather what's coming in 2026? I'm going to give you specific numbers today, not ranges, not "it depends." Actual targets based on what's happening right now in currency markets, debt spirals, and the physical supply chain that most analysts are completely missing. But here's the thing that is going to make some people uncomfortable. Most of you watching this don't have enough, not even close. And the gap between where you are and where you need to be is widening faster than your purchasing power can keep up. The standard advice you'll find online is laughably inadequate. 5 to 10% of your portfolio in precious metals. Maybe some preppers saying 1 ounce of gold per family member. These recommendations were developed in a different monetary era, when central banks weren't creating trillions out of thin air every time a bank sneezed, when China wasn't stockpiling thousands of tons while telling you metals are barbarous relics. Let me show you why this matters. We're entering the first year in modern history where every major economy is simultaneously debasing their currency while publicly admitting they can't stop. The Fed's balance sheet, the ECB's negative rate experiment that failed, Japan's yield curve control that's imploding, China's property sector requiring constant liquidity injections. This isn't theoretical anymore. In 2026, we're going to see the convergence of 3 separate crises that each individually would justify holding significant precious metals. Together, they create a scenario where the traditional allocation models become dangerously insufficient. First crisis, the municipal bond market. Nobody's talking about this. $37 billion in municipal bonds mature in the first quarter of 2026. Cities and states that haven't recovered their tax bases since the commercial real estate collapse. They'll refinance at rates 3 to 4 times higher than their original borrowing costs. Some won't be able to refinance at all. When municipalities start defaulting, that contagion spreads into money market funds, into the safe assets your financial advisor never told you were backed by insolvent local governments. Second crisis, the commercial mortgage maturity wall hits full force. We've been watching the slow-motion train wreck in office buildings and retail spaces. In 2026, over $400 billion in commercial real estate loans come due. Buildings worth 60 cents on the dollar trying to refinance debt that assumed they were worth 120. Regional banks hold most of this paper. We already saw what happens when a few banks wobble. Now multiply that pressure by 10. Third crisis, sovereign debt refinancing in developed markets. The U.S. Treasury needs to roll over $9 trillion in debt in 2026. $9 trillion. At interest rates that are double what they were paying 3 years ago. Every percentage point increase in rates adds $90 billion to annual interest payments. We're approaching a point where interest on the debt exceeds defense spending, exceeds Medicare. That's not a budget problem. That's a legitimacy crisis for the currency itself. Consider this for a moment. When all 3 of these crises intersect, what's the institutional response going to be? The same thing it's always been. Print, monetize, inflate. They'll use different words like quantitative easing or emergency liquidity facilities or temporary accommodation. But it means the same thing. Your savings get diluted to bail out the system. This is where gold and silver stop being investments and start being survival tools. So let's get to the actual numbers. How much do you need? I'm going to break this into 3 tiers based on what you're protecting against. These aren't investment recommendations. They're insurance calculations based on historical precedent and current vulnerabilities. Tier 1 is baseline survival insurance. This is protecting 3 to 6 months of living expenses in a scenario where currency instability makes your bank account temporarily inaccessible or severely devalued. Not Mad Max stuff, just the kind of banking system stress we saw in Cyprus, Greece, Lebanon, Argentina. It happens to developed economies more often than people want to admit. For baseline monthly expenses of $4,000, you're looking at protecting $12,000 to $24,000 in purchasing power. At current prices, that's roughly 6 to 12 ounces of gold, or 200 to 400 ounces of silver. I prefer silver for this tier because it's more divisible for actual transactions. Try buying groceries with a 1 ounce gold coin. The premium you'll pay in the exchange will kill you, but here's where most people stop. They hit this tier and think they're prepared. They're not even close to safe. Tier 2 is wealth preservation through currency crisis. This is where you're protecting your actual savings and investments from a 30 to 50% devaluation in purchasing power. Not hyperinflation, just the kind of steady destruction we've seen in currencies from the Turkish lira to the Argentine peso to the British pound during its bad decades. If you have 100,000 in savings and retirement accounts, you need to assume that in a moderate currency crisis, you'll need 30 to 50,000 in metal-backed purchasing power to maintain your standard of living while the system resets. That's roughly 15 to 25 ounces of gold. This is your serious money. This is what prevents you from becoming a poverty statistic when your 401k buys half what it used to. The implication here is striking. Most retirement accounts are denominated in the exact currency that's being systematically devalued to manage unpayable debts. You're holding the liability side of a balance sheet where the asset side is property that is overvalued bonds that are underwater and stocks trading at valuations that only make sense if interest rates stay at emergency levels forever. When I talk to financial advisors about this, they point to diversification within the portfolio. International stocks, bonds with different durations, real estate investment trusts. But all of that is measured in dollars. When the dollar itself is the problem, shuffling your exposure between different dollar-denominated assets is like rearranging deck chairs. Tier 3 is generational wealth protection and opportunity positioning. This is the level where you're not just surviving the crisis, you're positioned to acquire assets on the other side when everything's on sale. This is what the actually wealthy people do, the ones who bought property for pennies during the Depression, who scooped up stocks in the early 1980s when inflation finally broke. For this tier, you're looking at holding 10 to 20% of your total net worth in physical metals. If your net worth is $500,000, that's $50 to $100,000 in gold and silver. Roughly 25 to 50 ounces of gold, plus silver for liquidity. This seems insane to most people. That is because most people have been trained by 60 years of dollar dominance to think paper assets are real and physical assets are primitive. But talk to anyone who lived through currency collapse. Talk to the Venezuelans who wish they'd converted just 20% of their savings to gold when they had the chance. Talk to the Argentinians who've watched their currency reset 4 times. They'll tell you 20% sounds conservative. Now, here's the part nobody wants to hear. These tiers assume you can still buy it anywhere near current prices. The physical market is already showing stress fractures that suggest we're approaching a breakpoint. The premium on physical over paper spot price is widening. Delivery delays from major mints are extending. The spread between bid and ask is expanding. These are all symptoms of a market where paper price discovery is diverging from physical availability. I track dealer inventory data that doesn't make it into mainstream analysis. In the past 6 months, secondary market gold inventory among mid-sized dealers has dropped by 38%. Silver is worse, down 44%. These aren't the big players like at Pemex who have deep supply relationships. These are the regional dealers who serve retail buyers like you. When they run low, it means the pipeline from refiners to distributors to dealers is tightening. This changes everything. Because if we hit a genuine currency crisis moment in 2026, if one of those 3 crisis scenarios I outlined actually triggers, the premium on physical is going to explode. We saw this in 2008 when gold was trading at $800 on the paper markets, but you couldn't buy physical for less than $950. We saw it again in March 2020 when the spread hit $300. In a real crisis, it could hit 500, 1,000, who knows. At that point, the whole question of how much do you need becomes moot because you can't get it at any price that makes sense. So let's talk about what's actually achievable for different income levels, because I know some of you are thinking these numbers are impossible. If you're making $50,000 a year, getting to Tier 1 is achievable over 6 to 12 months by allocating 10 to 15% of monthly income. That's $500 to $600 a month. In a year, you've got 200 ounces of silver, which covers 3 months of basic expenses at current ratios. You're not rich, but you're positioned better than 90% of your neighbors. If you're making $100,000 a year, you should be targeting Tier 2 within 18 to 24 months. That means allocating $1,000 to $1,500 monthly. It's aggressive, but we're talking about protecting decades of wealth accumulation from a policy environment that is explicitly designed to erode purchasing power. The Fed's own target is 2% inflation, which means they're officially trying to make your money worth less every year. And that's when they're hitting their target. When they lose control, it's exponentially worse. For higher earners, the question isn't whether you can afford to allocate to Tier 3, it's whether you can afford not to. If you're pulling down $300,000 a year and you don't have at least $30,000 to $50,000 in physical metals, you're making a bet that the current system is sustainable. Look at the debt numbers. Look at the refinancing walls. Look at the political incentives. Does that look sustainable to you? Here's why that matters. The safety question in the title is not really about having enough to survive. It's about having enough that you don't become dependent on a system that is going to prioritize institutional stability over individual rights. We've seen this movie before. Bank holidays, capital controls, forced conversions, negative interest rates, bail-ins where depositor accounts get converted to bank equity. Every single one of these policies gets floated during crisis moments, and every single one of them transfers wealth from individual savers to the institutions that created the problem. When you hold physical gold and silver, you're holding assets that exist outside that control system. They can't confiscate what they can't access. They can't freeze what's not in their system. They can't bail in what you hold in your hand. Now, I know what some of you are thinking. What about confiscation? Didn't FDR do that in 1933? Yes. And it's worth understanding what actually happened versus the mythology. Roosevelt ordered citizens to turn in gold coins, bullion, and certificates in exchange for dollars at $20 per ounce. Then he immediately revalued gold to $35 per ounce, effectively devaluing the dollar by 40%. If you held dollars, you lost 40% of your purchasing power. If you held gold and didn't comply, you maintained purchasing power. Compliance was actually pretty low. Estimates suggest only 20 to 30% of private gold was actually turned in. There was no door-to-door enforcement. There were no systematic audits. The penalties existed, but were rarely enforced. Most people who held physical kept it and waited. Could it happen again? Maybe, but the dynamics are completely different. In 1933, the US was on a gold standard and the government needed to break the link to reflate. Today, we're on a pure fiat system. The constraint isn't gold, it's confidence in paper currency. Confiscating gold doesn't solve that problem, it exacerbates it by confirming that metals are the real money and paper is the pretender. More likely is what we're already seeing, taxation through inflation while demonizing gold and silver holders as hoarders or speculators. They don't need to confiscate if they can just make holding dollars so painful that you're forced to spend or invest in tracked, taxable, controllable assets. The other question I get constantly, what about silver versus gold ratio? Right now, we're sitting around 90 to 1. Historically, it's been in the 50 to 70 range in modern markets and 15 to 1 when both metals were monetary standards. The argument for silver is that ratio compression could give you double benefit. The absolute rise in precious metal value plus the narrowing of the spread. I hold both, but weighted differently by tier. For Tier 1 immediate needs, I'm heavy silver because of divisibility. For Tier 2 wealth preservation, I'm probably 60-40 gold to silver. For Tier 3 generational and opportunity positioning, I'm 70-30 gold because of density and portability. If you need to move significant wealth quickly, gold is exponentially easier. But here's a consideration most people miss. Industrial demand for silver is actually accelerating even as investment demand increases. Solar panels, EVs, electronics, all consuming silver at rates that are outpacing mining supply. Gold is mostly monetary and jewelry. Silver has to serve both monetary and industrial functions. That creates a squeeze potential that gold doesn't have. Consider this for a moment. If solar deployment continues at projected rates, industrial silver demand alone could consume 90% of annual mining supply by 2028. Add investment demand on top of that, and you've got a structural deficit that can't be resolved by price alone because mining supply is relatively inelastic in the short term. That's the kind of setup where silver could massively outperform gold, or it could stay suppressed by paper market manipulation, while industrial users get priority allocation and retail investors get waitlisted. The physical market and the paper market are increasingly separate ecosystems. This gets to a critical point about where you buy and how you store. Paper gold and silver, the ETFs and futures contracts, are not the same as physical. When the stress comes, paper holders find out they own promises backed by fractional reserves. The big ETFs claim to hold physical, and maybe they do in aggregate, but you don't own specific bars. You own shares in a fund that owns bars, and in a crisis, good luck getting delivery instead of cash settlement. Physical means you can touch it. Coins, bars, rounds, held either personally or in allocated storage where specific serial numbered bars are assigned to you. Not pooled, not unallocated, not paper claims. For most people, this means buying from reputable dealers and storing at home or in a private vault, not a bank deposit box, because when banks close during a crisis, you can't access those boxes. Private vaults with segregated storage where you can audit your holdings. The security question is real but manageable. A good safe, properly installed, deters casual theft. For larger holdings, geographic diversification makes sense. Some at home for immediate access, some in a vault for bulk storage, maybe some overseas if you're concerned about jurisdiction risk. The point is, you need to think through the access and security balance for your specific situation. There's no one-size answer, and anyone who tells you there is doesn't understand the variability in individual threat models. So what does all this mean for you? If you're sitting here with less than 50 ounces of silver and no gold, you're not remotely prepared for what the bond markets, the commercial real estate sector, and the sovereign debt crisis are going to throw at us in 2026. You're hoping the system holds together long enough for you to retire, downsize, or somehow escape the consequences of policies that are mathematically terminal. Hope isn't a strategy. If you're at Tier 1, you've got basic crisis insurance, but you're not preserving wealth, you're preserving survival. That's not nothing, but it's not enough to avoid serious lifestyle degradation if we get sustained currency devaluation. If you're at Tier 2, you're actually positioned to weather this. You'll take losses on your paper assets like everyone else. But you've got a reserve of purchasing power that lets you wait it out and maintain your standard of living while others are forced into crisis sales and bad decisions. If you're at tier 3, you're going to come out of this in a stronger relative position than you went in. While everyone else is liquidating at the bottom, you're buying. While everyone else is panicking about how to pay bills, you're looking at opportunities. That's not being predatory, that's being prepared. The cut to answer the title question directly is roughly this. If you don't have at least 100 ounces of silver or equivalent gold value per household member, you're probably not safe for what's likely coming in 2026. That's baseline. For actual wealth preservation, triple that. For opportunity positioning, multiply by 10. Most of you don't make the cut yet. But you've got time. Not much, but some. The dealers still have inventory. Premiums are elevated, but not catastrophic. You can still accumulate at prices that will look like gifts a year from now. The question is whether you're going to act while you still can, or whether you're going to wait until the crisis is obvious to everyone, at which point availability disappears and premiums go vertical. I've given you the framework. I've given you the numbers. I've shown you the converging crisis points that make 2026 different from every other year. People have been predicting precious metals necessity. The institutions know this. Why do you think central banks have been net buyers of gold for 14 consecutive years? Why do you think China has been acquiring thousands of tons while their state media tells you metals are a foolish investment? They're telling you one thing while doing the opposite. You're in a rigged game where the house is hedging against its own currency while telling you to keep playing with chips. At some point, you have to decide whether you trust what they say or what they do. Your move.